Sell everything now. Show me the money. Oh, hey there. Holy flippity flip flop flap and smokes, everyone. We are witnessing an absolute bloodbath in the markets today after this report that is terrifying Wall Street. We have some things developing now that are absolutely shocking, and are also what's very, very spooky is the market crash that we saw in 1987 in October. All the things that are happening in the market right now is exactly what led up to the crash in 1987. We are seeing complete bloodbath in the pre-market. Bond yields are spiking again after this one report that I've been warning you about could be big trouble for the markets. So what exactly is this report that came out that has got everyone on Wall Street so worried, and also the bankers, the central bankers? Well, that's exactly what I'm going to cover in today's video and tell you what this means for you, me, and how we can prepare for this. So everyone, without further ado, let's get straight into the news, the facts, and the data. So look at this, everyone. Stock futures drop, yields rise after jobs report market wrap. So this is the market wrap of what exactly is going on right now. Now you may think, jobs report? What's so terrifying about that? Well, yes, if you're someone looking for a job, it's not terrifying, but all the billionaires and oligarchs on Wall Street, is very, very worrying for them and their portfolios, because it means central banks are going to have to keep on lifting interest rates much higher than everybody expected. And if interest rates keep going up and yields get close to the returns you can see in a stock market of 7%, people are going to stop investing in stocks. They're actually going to sell their stocks because stocks are at record highs. Still, they're still in bubble territory, and they're going to park their money in treasuries for the short term and wait for the crash. So let's dig a bit deeper into this report here. So US indexes fell, bond yields, well, it was skyrocketed again. We'll go ahead and have a look at the live market reaction now. We can see here Dow's down over 200 points in the pre-market. We'll see what happens at the open if the plunge protection team comes in there to save the day, or if the sell-off gets worse. We can see the S&P is down almost 1%, the Nasdaq's down 1.2%. Now if we go here, look at this. 10-year yield is approaching 16-year high to what led up to the 2008 crash. We'll load up the dollar, the DXY. Look at this spike here. We can see it was trending down lower, and then this jobs report came out, which again we'll get into in a moment. It absolutely skyrocketed. And we can see all yields here. The 3-month now 5.5%. The 2-year 5.1%. And look at this, the 30-year is now over 5%, and the 10-year is almost 5.9%. So let's break this report down. So payrolls increased by 336,000 in September. This was nearly double the estimate, as we can see here, of 170,000. Now again, why is this so worrying? Well, because the Federal Reserve actually wants to take some of the heat out of the labor market. They want the unemployment rate to go up to try to reduce inflation. Again, I'm just reporting how this system works. Is it a perfect system? No, it is not a perfect system at all. But that's what they're trying to achieve. And they've had to lift interest rates almost to 5.5%, and it has not even put a dent in the, should I say, the official government figures of the labor market. We all know the real unemployment rate's much higher, but for now, it is being much more resilient, which means there's going to be more pain coming. So it increased by 336,000, and the unemployment rate held at 3.8% compared to the forecast 3.7%. We can see this chart here of every single monthly job creation in the US. We can see it here has spiked up, and you know that's kind of normal towards the end of the year. So we can also see average hourly earnings, they're continuing to not keep up with inflation. So again, wages going up 0.2%, but inflation is going up much faster than this. Now also, let's figure out what industries these jobs are coming. Are people getting high-paying, good quality jobs? No, unfortunately, a lot of the jobs are just coming from low-paying leisure and hospitality. And that's why You can't just look at the unemployment rate and think, wow, there's a lot of people employed. Well, yes, if they're just in leisure and hospitality jobs that are paying $15 an hour and they're only getting 10 to 20 hours per week, that's not enough to, pay rent, pay fuel, pay groceries, etc. So again, you have to look a bit deeper. It also includes 73,000 government jobs, 41,000 healthcare and professional, scientific and technical services, 29,000. Motion picture and sound recording jobs fell by 5,000 and are down 45,000 since May. I guess we're seeing all the troubles going on with Hollywood, as we can see here. So in addition to the powerful September, the previous 2 months saw substantial upward revisions. So again, these economists can't seem to get it right. August gain is now 227,000, up 40,000 from the prior month, while July went up to 236,000. That's from 157,000. So combined, the 2 months were 119,000 higher than previously reported. So again, guys, these aren't just small misses. These are huge misses. And who knows what's going to happen with this data, if it's going to be revised higher or lower. So the labour force participation rate, or those working against the total size of the workforce, held steady at 62.8%. So, okay, let's dive a bit deeper to what else people are worried about in the markets right now. So a global bond sell-off is happening now, as we can see here. I'll just go ahead and highlight this for you so it's a bit easier to read. Has been hammering risk assets from stock to corporate credit on concerns that central banks will keep rates elevated longer than expected. And a 30-year yield, like I showed you here, has now passed 5%, which is absolutely crazy. And I think we're going to see a lot of big money park short-term into short-term treasuries, like a 3-month or a 6-month, where you can get a 5.5% return until you wait for the dust to settle to figure out, are central banks playing chicken? Will they stop inflation? Or will they just try to come up with some excuse not to lift interest rates every single month? So traders have recorded sums riding on the outcome of the November's Fed meeting as investors and policymakers debate the likelihood of a further increase this year. So pretty much right now, the markets are pricing in a 60% chance that they will hike by December. And I think they should definitely hike next month. We can see here that the inflation data is coming in hot, the employment data is coming in hot, so they need to keep on lifting interest rates. But again, that's bad news for the banks, because the whole reason why the banks failed in March was rising interest rates, and all the bonds that they held on their portfolio, they all crashed. Well, guess what? Bonds are crashing now. Even the bond market's even lower now than it was in March. So we're going to see more pain coming. So we've got the DXY there. Also, what's going to be big trouble for the banks is a severe crash is coming for US commercial real estate. This is not just happening in the US, Australia, Europe as well. As the work from home movement continues, as less and less people go into work, we're going to see these properties' rents go down. And now with higher interest rates, normally what they look at in real estate is a cap rate. And before, people would be like, wow, if I can get a 6% yield on commercial real estate, that's really good. Well, now you can get nearly a 6% return in treasuries or a money market fund. So why would you deal with the hassle of renovations, maintenance, tenants with commercial real estate where you can just put it in a bond and do nothing? Now, also more bad news for the economy. Personal income fails to keep up with spending for 3 months. And we saw that just with this report, wages are only going up 0.2% when inflation is much higher than this. And personal income is not keeping up with people's spending. And we got the latest credit card data, and people's credit card spending has collapsed because they've all maxed out their credit cards. Now, like I was talking about, what we're seeing happen right now in the markets is what led to the Black Monday in October, where the Dow plunged nearly 33% in just one day. So let's have a look at some of these charts and see how close it is today. Sorry, let's clear my throat there. So no one wants to remember 1987, then there's 1916. So comparisons for bond yields bear a scarily unwelcome resemblance to 36 years ago. Meanwhile, Japan tries a Verdun strategy. So Japan, they need to figure out what they're going to do with their yield curve control. So look at this. Look at this chart here while I have a drink of water. So run for the hills, Bloomberg is saying, looking at this chart. So I'll try to make it a bit bigger here and move myself so it's a bit easier for you guys to see. So yes, 2023 yields spike does look a lot like 1987 year of Black Monday. So we can see the blue line here is a 10-year yield starting from the 1st of the 1st, 1987, and the black is the 10 years starting from the 1st of January 2023. So look at this, everyone, almost identical. So could we see a Black Monday in October like we did in 1987? Maybe not as bad as 1987. I think it's unlikely we'll see it that bad. But the way the bond market is going right now, I think we're going to see something break, kind of like what we saw with the repo market in 2019. So also here, avert your eyes. So this is another scary chart here. The NASDAQ progress this year is spookily similar to the Dow in 1987. So look at this chart, everyone. So again, the blue line is the Dow in 1987. The black is the NASDAQ 100 in 2023. Look at the lead up. Again, what's very, very worrying is why is the stock market still at record highs when bond yields are this high? It doesn't make sense, and they're simply going to have to sell off, especially once we enter recession. Sorry, guys, my voice is still recovering. And another chart here. The chart that spooked traders in 1987, the Dow was starting similar in the 12 months before, and also in 29 and the 87 crashes. So everyone, again, for those joining in right now, the jobs report came in very hot, double than estimate. This is causing bond yields to surge, is causing the dollar to surge, and I think we are going to see something break in the financial system, and it's going to cause the stock market to crash. So what do you all think about this? Let me know down below. Thanks for watching. You're awesome. I'll see you all in the next video.